Fed meetings create some of the biggest market moves in the shortest period of time. In this video, you're going to be learning a strategy that allows you to capture huge moves without having to guess the direction. Let's jump into it.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk. And one thing that should be pretty obvious to active traders this year is that anything that traders believe will have an effect on the Fed's decisions about interest rates and monetary policy is going to be a major market moving event, whether it's the monthly non-farm payrolls report, the CPI report, or any other inflation-related report, and obviously the FOMC meetings themselves. And in turn, these major events create huge opportunities for day and swing traders as well, if you can catch one of these moves early. But what most traders don't realize is that there are option strategies that can be implemented prior to any major announcement that can be incredibly powerful, especially in very large market moves. And the best part is that the strategy is not only easy to learn, but it requires very little capital compared to most day and swing trading strategies, and doesn't require you to in any way predict how the market will react to the announcement. Now, before we get into the details of this trade, which really can be implemented prior to any big market moving event, I wanted to let you know that if you'd like to learn 3 more option strategies that our pro traders use all the time, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market moves up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on the direction, then click the link that should be appearing now at the top right corner of your screen. That's going to open up a free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this, so pause this video, sign up now, and then resume watching. Okay, so in order to explain how this strategy works, we need to make sure that everyone watching this video understands how index options work. So we're going to do a really quick review of them, and then we'll jump right back into the details of the strategy. And so the best way to understand index options is to think of them as bets. What are known as call options pay off if an index closes above what's known as the strike price of the put on the day that the options expire. If the index does close above that price on expiration day, then the call buyer gets $100 per point that the market closes above that call strike price. A put option is the exact opposite. It pays off if the market closes below the strike price of the put option. Again, $100 per point that the market closes below the strike price of the put. So for example, if an index closes at 40.32, then the 4,000 call would pay $3,200, as you can see from the calculation, because the index closed 32 points above the strike price of the call, which is 4,000. However, the 40.75 call would expire worthless, as the index didn't close above 40.75, so the call seller just pockets the premium. And the puts, well, they're just the opposite. If the market closed at 40.32, then the 40.75 put would be worth $4,300 because the market closed 43 points below the put strike price of 40.75. But the 4,000 puts would expire worthless because the market didn't close below the 4,000 strike price. With that said, last week, as I'm sure you're all aware, the Federal Open Market Committee, the FOMC, held its 2-day meeting, which takes place every 6 weeks. And at 2 p.m. on the second day of the meeting, which is always a Wednesday, the FOMC releases a statement as to its decision coming out of those meetings, including any changes to interest rates and any plans involving quantitative tightening or easing. And then at 2:30 p.m. that same day, the chairman of the Fed makes a statement, and then he holds a press conference. And so let's take a look at the S&P 500 index since the beginning of the year. And as you can see, it's been pretty rough, with the market reacting very adversely to the constant barrage of out-of-control inflation reports, followed by extreme reactions from the Fed in the form of aggressive monetary policy measures to try to rein that inflation in. And so in a kind of classic bear market fashion, the SPX index has been making lower lows and lower highs all year, approaching the November meeting of the FOMC. So let's say that on the afternoon of November 1st last week, one day before the FOMC announcement the next afternoon, at the end of the day, you pull up an options chain that's going to expire at the end of the next day, the day of the FOMC announcement, and you buy what options traders refer to as an at-the-money long straddle at the 38.60 strike price, which is the closest 10-point strike to the market price of the index at the end of the day. A straddle is a call and a put at the same strike price expiring on the same day. And as you can see, we bought two straddles because we bought two calls at the 38.60 strike and we bought two puts at the same strike. And as you can see, the call cost $28.85 and the put at that same strike, that's 38.60 strike, cost $31.90. And so the total cost of the long straddle was actually $60.75 per lot. Now, before we go any further, let's take a look at what this means from a capital and cash flow standpoint, so you'll understand the requirements of this particular trade. And so first of all, as you can see, the calls we bought cost $28.85, and remember, each option represents $100 per point beyond its strike price on expiration day, and so you multiply that by 100, and we bought two of them, so that's a total cost of $57.70. And by the same logic, the $31.80 price of the long puts translates into a total cost of $63.60, resulting in a total cost for the straddle of $12,150 for the two straddles. And so that's your risk on the trade. Now, the next day, the FOMC wrapped up its meeting, and at 2 p.m. they announced yet another 75 basis point increase in interest rates, which the market actually looked well upon, and a rally ensued. But then, a half hour later, when Fed Chairman Powell spoke, he made it pretty clear that the Fed is not even thinking about pivoting to an accommodative monetary policy when there's still no real evidence that inflation is moderating. Well, as soon as he said that, the market tanked and never looked back, so that by the end of the day, the SPX index had shed almost 100 points on the day, closing at 3758.68. And so, predictably, the market had a huge response to the Fed's decision and subsequent commentary. And so now we need to turn our trade to see what this actually means for that long straddle trade that we brought the previous afternoon. And so the first thing to realize is that once the final print of the SPX is established at 4 p.m. on the day the options expire, you can establish the exact settlement value of the options. And so with the SPX closing at 3758.68, let's take a look at how that values each of the individual options. Well, the calls are easy because remember, index calls only pay off if the market closes above the strike price of the options, and those calls are located almost 100 points above where the market closed, and so those obviously have no value. So now we turn to the puts, and of course those are very valuable because they pay off $100 per point that the market closes below the strike price. And as you can see from the calculation, the market closed 101.32 points below the 38.60 strike price. So you multiply that by 100 for each point below the strike, and we bought two of them. So the final value of the puts is $20,264. And since the calls were worthless, the final value of the straddle is nothing more than the final value of the puts, which comes again to $20,264. And of course, to calculate the profit, you need to subtract out that original cost of $12,150 to arrive at a final trade profit of $8,114, which comes to more than a 66% return on the original capital. And remember, we did that overnight, which is not too shabby. Now, an important thing to keep in mind about the trade is that while one of the options of a straddle, either the call or the put, will always have value at the end of the day, just like the other one will always have no value at the end of the day, the one that does have value has to be settled for an amount larger than the original cost of the straddle in order for the trade to make a profit. And so it's always a good idea to look back at how much the market moved after previous Fed meetings to see if in previous cases the market movement would have been enough to have made this current straddle profitable. If the answer is no, then you might want to stay away from this trade for that particular cycle. So what I'd like you to take away from today's video is that the at-the-money straddle prior to huge market moving events like an FOMC interest rate decision offers tremendous potential for a very substantial win, particularly if there's a relatively recent history of the market moving an amount larger than would be necessary for the straddle to settle for a value greater than its cost. By carefully studying previous FOMC announcements and calculating the market moves which resulted from those, professional traders can put themselves into a position to make exceptional profits. And the best part is that the whole process takes just one day. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can head on over to optionsclass.com to register for this free workshop directly. It's really a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.
It's time for you to go out and experiment with the trading strategy you just learned. But before you do that, make sure to click the video appearing on your screen to learn a simple technique that can literally triple your options profits potential.